Welcome to the complete series recap for ASC 323, Equity Method and Joint Ventures. This video brings together every major concept from all 7 sections of the training. If you have been working through the series, use this as your consolidation review. If you are joining for the first time, this recap will give you the full map before you dive into the individual sections. 7 sections, 7 building blocks. Together, they cover everything you need to apply the equity method correctly under U.S. GAAP, from the initial classification decision all the way through to period-end procedures and audit readiness. Let us walk through the highlights of each one. The starting point for all of this is model selection. U.S. GAAP has 3 investment accounting models, and the choice between them drives everything else. The fair value or cost method applies when you have no significant influence. The equity method applies when you have significant influence but not control. Full consolidation applies when you have a controlling interest. Get this decision wrong and you have a material misstatement. The equity method applies when you have significant influence, the ability to participate in, not control, the investee decisions. The 20 to 50% ownership threshold is a presumption, not a bright line. Facts can override it in either direction. A 25% owner with no board access and restricted voting rights may have no significant influence. A 15% owner with a board seat and veto rights almost certainly does. When you acquire an equity method investment, it goes on the books at cost the total price paid, including transaction costs where applicable. The more complex situation is a step acquisition, when you already hold a small stake and then buy additional shares that push you into significant influence territory. At that point, you need a catch-up adjustment, remeasuring the prior stake as if the equity method had always applied, with the difference running through current period earnings. This formula is the engine of the equity method. Every period you start with the opening investment balance, add your proportionate share of investee net income, subtract dividends received, subtract basis difference amortization, and subtract any impairment. The result is your closing balance. Dividends are critical to understand correctly. They reduce the investment, not income. You have already picked up your share of earnings. The dividend is just the investee converting your investment balance into cash. When you pay more for an equity method investment than your proportionate share of the investee net book value, you have a basis difference. That difference needs to be allocated just like a full purchase price allocation, but in miniature. Each piece is assigned to the underlying asset or liability it relates to and amortized over the remaining useful life. The goodwill portion sits inside the investment balance and is not separately amortized, but it is part of the impairment test. When the investor and investee transact with each other, you need to think about unrealized intercompany profits. If the investee sells goods to the investor and the investor still holds them at period end, the profit sitting in the investee income statement has not yet been earned from the perspective of the combined entity. You must eliminate your share of that unrealized profit from your equity pickup. The same logic applies when the investor sells to the investee. What happens when cumulative losses drive the investment balance to zero? You stop. You cannot carry the investment negative unless you have guaranteed the investee debts or committed to provide additional capital. When zero is reached, document the suspended loss amount and monitor the investee results each period. If the investee recovers and returns to profitability, you resume equity pickup, but only after offsetting the suspended losses first. Impairment of an equity method investment uses the other than temporary impairment model, a single judgment call about whether the decline in fair value below carrying amount is permanent in nature. If the conclusion is yes, you write the investment down to fair value. That write-down establishes a new cost basis and cannot be reversed in future periods, even if the investee recovers. This is one of the key differences from the IFRS approach under IAS 36. Ownership changes introduce complexity. If you acquire more shares and gain control, you step up to full consolidation and remeasure the prior equity method investment at fair value on the acquisition date. If you sell shares and fall below the significant influence threshold, you reclassify the remaining stake to the cost or fair value method under a SC 321. In each case, the change triggers a remeasurement and typically recognition of a gain or loss. Dividends from an equity method investee always reduce the investment balance, never income. A special case is the liquidating dividend, where the investee distributes more than the investor's share of its cumulative undistributed earnings. When that happens, the excess reduces the investment below original cost, but is still not income. It remains a return of capital until the balance reaches zero. Joint ventures under U.S. GAAP use the equity method, not proportionate consolidation. This is an important distinction from IFRS practice for joint operations. If you contribute non-monetary assets to a joint venture, you recognize the gain or loss at fair value at the date of contribution, to the extent of the other venturer's interests. The joint venture then applies the same equity pickup, basis difference, and OCI mechanics as any other equity method investment. Section 5 also consolidated all 8 journal entry scenarios you will encounter across the life of an equity method investment. From initial acquisition at cost all the way through to disposal, each entry follows a consistent logic. The investment account is the anchor, and every economic event either increases or decreases it with income, OCI, or cash as the offsetting element. Knowing these 8 entries cold is the foundation of clean equity method accounting. On the face of the financial statements, equity method investments have a distinctive presentation. The balance sheet shows a single line for the investment. You do not gross up the investee assets and liabilities. The income statement shows equity in earnings or losses, typically outside operating income. Your share of investee OCI flows through your own OCI, and dividend cash flows need careful classification depending on whether they represent income or return of capital. ASC 323 requires meaningful disclosure about equity method investments. Investors must disclose the name of each significant investee and the ownership percentage, the accounting policies applied, and any difference between the carrying amount and the underlying equity in net assets. If the investee is material, summarized financial information is also required. Any impairment charges must be separately disclosed. These disclosures give financial statement users the information they need to understand the exposure. If you work in a dual reporting environment, the IFRS differences matter. The biggest gap is joint operations. IFRS 11 requires proportionate consolidation for joint operations, which produces very different financial statement results than the U.S. GAAP equity method. On impairment, both frameworks use a single-step approach, but IFRS allows reversal of impairment losses if the recoverable amount increases. U.S. GAAP does not. Knowing which framework applies to which entity is critical when producing parallel sets of financial statements. Section 7 addressed the operational risks. These 5 mistakes are the most common sources of errors and audit findings in equity method accounting. All 5 are preventable with the right procedures and active period-end monitoring. The common thread is discipline. The equity method requires ongoing judgment and adjustment every single period, not just at initial acquisition. Audit readiness for equity method investments comes down to one principle. Your work papers must tell the complete story without verbal explanation. Every number must trace to a source document. Every judgment must be documented with the rationale. The 5 audit areas: investee financial statements, basis difference, equity pickup, impairment, and intercompany, are the 5 places where auditors will dig, and being prepared in all 5 before fieldwork begins is the standard to aim for. The 3-tier role structure ensures that equity method accounting has appropriate oversight at every level. The team member prepares and flags. The team lead reviews and escalates. The manager approves and signs off. No one resolves judgment calls alone, and no one reviews their own work. This structure is not about bureaucracy. It is about ensuring that the accounting conclusions are reached by the right people with the right experience. Before we close, here is the complete equity pickup in one view. This is the reconciliation that connects every concept in the series: the opening balance, the income pickup, the OCI pickup, the dividend reduction, the basis difference amortization, and the impairment floor at zero. Every number in this reconciliation has a source document behind it. Every line connects to a concept covered in this series. This single schedule is the heart of equity method accounting. One of the most important things to carry from this series is that a SC 323 does not stand alone. It is connected to a SC 321 when significant influence is absent, to a SC 810 when control is achieved, to a SC 35020 for the goodwill embedded in the investment, and to a SC 820 when measuring fair value for impairment or basis difference allocation. Understanding these connections helps you navigate the more complex situations you will encounter in practice. The period-end checklist is how all 7 sections come to life in practice. Every step on this list connects to a concept from the training. Obtaining the investee statements connects to the audit work papers. The equity pickup connects to the measurement section. The OCI pickup is one of the 5 common mistakes. Dividends are another. Intercompany eliminations are a third. The zero balance check is the loss limitation rule. Work through this list consistently, and you will catch the errors before the auditors do. Here is a quick reference for the 5 most frequent decision points you will face. Each question maps to a rule from the series. Is there significant influence? Check the 20 to 50% presumption and the substance of the relationship. Did you pay a premium? Run the basis difference analysis. Is the balance at zero? Stop. Did a dividend arrive? Reduce the investment. Are there intercompany goods still unsold? Eliminate the profit. These 5 questions cover the majority of real-world equity method situations. The equity method is one of the most judgment-intensive areas in U.S. GAAP accounting. It requires the right model selection, precise ongoing measurement, rigorous documentation, and an effective control structure. Everything in this series builds toward one goal: giving you the knowledge and the tools to apply a SC 323 correctly, consistently, and with audit confidence. Thank you for completing the full ASC 323 Equity Method and Joint Ventures Training Series. If you found this useful, subscribe to our channel for more PNJ Group training content. Thank you for watching. Subscribe for more training from PNJ Group.